Good morning, everybody. Mike here, Insider's Edge Coaching. Lessons today in this recording are on a bias called self-serving bias. And the end result of it is how to make better decisions. And I've got a great case study to share with you about this. And I mean, when I say great, it just happened yesterday. So, everything's fresh in your mind. I journaled it. I'm going to bare my soul, and everybody's going to, kind of learn something from it. Okay. So let's go ahead and get started on the lesson. All right. So this chart right here is a stock BNTX that we just got in 2 days ago. I think what's my entry? Well, I got in on the 10th and the 11th. I was scaling in. So where is that? 5. There's 11. There's 10. Okay. And obviously, you would love to have a strategy that did this immediately, like 2 days, but they're rare. But they happen. Okay. And one of the things about trades that are rare but still happen is you don't get enough practice with them. You get a lot of practice with trades that take some time to evolve. But ones that you press you hit a mouse button and 2 days later you're up 800%. We don't. I'd love to have more practice with them, but it's just not the way it works. Okay. But there's plenty of lessons to learn from this, and I'm going to share it with you. Okay. First thing is, I was reading a book this week, and if you read the blog every day, there was a small version of what I'm going to go over with you now. But this is way better because there's a case study built into it. But the name of the book is Thinking in Bets, Making Smarter Decisions by Annie Duke. Now, Annie is arguably the best female tournament poker player in history in terms of winnings. And this book is not about poker, although she uses a lot of analogies and metaphors to the poker table in the book. All right. The book, and by the way, I didn't know this until I started reading this book. I mean, I knew who she was as a poker player. But she's got a PhD in psychology. This is a highly educated person with multiple degrees. And so this book is really about psychology. And the poker part is just a little bit metaphor here and there to show examples of what she's saying. She's describing. Very well researched. A lot of great citations to other books. Strongly encourage you to buy and read this book. It was so interesting to me that my first sit down with it, I read half of it, almost half of it. Just couldn't put it down, had other things to do, had to take a break, but you will not be disappointed. It will help you in life. It will clearly help you in all the areas of decision making that you have. And then obviously that becomes trading as well, gets you better as a trader. All right. Okay, let's see if there's anybody new. Karen Enderly, welcome. Didn't see you last week. Got a new member on the team. All good. Who else? Sebastian's here. Good. Welcome, Sebastian. Yeah, it looks like the only new names I see. Okay, cool. All right. So get the book and read it. Now, what I found was one of the things that, in trading, if you've been around it for any length of time, we quickly realize that it's more psychological than it is mathematical. The math is pretty simple. I mean, unless you're coding complex algorithms, which I'm pretty sure none of you are, it just gets down to the issues we have as human beings, that winning is good, losing is bad, got to be right, don't want to be wrong. And then there's a lot of other biases that come into play Dozens of them, actually. It's a fascinating subject. You should, look into that as well. But the one that I discovered while reading her book, I had not seen before, and it was called Self-Serving Bias, right? And I'm going to give a one paragraph example of it, but you really need to read the book to get a complete and thorough understanding of how important noticing this bias is and eliminating it. But basically, the bias has us giving credit to our skills when we win and blaming bad luck when we lose. It also has a tendency to say our competition, when they won and we lost, was lucky. So it's a real egotistical bias, and it's pervasive. The number of examples she gives, a lot of them are very subtle. So you may be reading this and going, "Oh, that's not me," but no, everybody has it, because essentially, no matter what we're doing, both skill and luck are part of the outcome. Nothing is truly 100%. There's gray areas in this, and what we need to do is acknowledge that to be able to improve our performance. And of course, the obvious problem with the bias is that it will prevent you from learning from your failures if all you do is lose a trade and say, that was just bad luck. I know what I'm doing, right? So we absolutely must learn a process to, and it's a decision-making process to be able to handle the outcomes, whether they were lucky or whether they were skilled or whether they were a combination. And the vast majority of them are going to be a combination, right? And, and as learned as she is, she admits in the book, she says, look, I struggled with this bias for a while, and eventually did enough research on it. She came up with a way to handle it. Now, I'm not going to be able to teach you the whole handling for it because it's a book. That's why I want you to read the book. But I'm going to go over some key points from it in this case study I'm going to show you. And essentially what we're going to want to do here is understand that any outcome in life, whether it's driving from here to a restaurant tonight, involves both skill and luck. Or whether it's putting on a trade, or whatever decision you're making, there's a combination and a grayness to the outcome being skill or luck, good or bad, right? So clearly, learning it, acknowledging it, and then being conscious when you're acting it out is going to take some practice, all right? So what are you going to do? Simply, you need to review every trade objectively. And when you review it, you want to put your attention on your decision-making process, not the outcome of the trade. The outcome's done. You either made money, lost money, broke even, whatever it is. But analyzing your decision-making process, do you have rules? Did you follow them? Did you deviate a little bit into those gray areas? And are you journaling your analysis? Okay. So we're going to go through my journal from yesterday on this trade. And like I said, bearing my soul here and being objective. So this was the trade. It was BNXT. Got in it here and here, scaled in, averaging $1.92 a share. Okay. And but I didn't get filled on subsequent contracts. My plan was, and my plan says, I never trade less than 3 contracts, and that is because that's how I scale out of trades. That's my comfort for getting out of a winning trade. And the more the merrier, obviously. But I only got filled on 2 of them. And I wasn't paying enough attention to just go in and make sure I changed my bid on the option to get into the third contract. I kind of let that slip. So now I'm stuck with, I can't execute my scaling out rules because I only have two, and I'm going to have to make a discretionary decision. All right. So let me pull up the chart here as I go through this, because it'll be more fun this way than just reading this. That first 30-minute candle yesterday. All right, so we're in here, we're making a little bit of money. That first 30-minute candle, in fact, I didn't even let it go to 30 minutes. I think I was on a 15-minute candle. It was a really big move up. Quit, in the first 15 minutes of the day. And I said, all right, I'm looking at the options. They're trading at 7. And I was averaged in at a little less than 2. Now, my rule for my first exit when I'm scaling out is one that eliminates all the risk from the trade. If that one contract takes out what I paid for the trade, I'm good to go. And obviously, with 2 contracts here, I only had $400 in the trade. I never got to my number. And this was, took out all the risk. In fact, at $500 in profit, it actually gave me a little bit of profit if the other the other contract went south. So I filled it at $7, right according to plan. Good job, Mike. Didn't get greedy, took one off. And I even made mention of it. I think we were in the futures trading room when I did this, because you could see, I'm going to just show you an example of one that didn't work that way. Here's Delta the other day, gapped up here. That green candle was pre-market, gapped up to open here at 46. Massive winner, had one left. And I was jerking around with trying to get a price on it. And then as it started to fall, I didn't just mark it out. I said, no, I got till October. Let me come back to it later in the day. So when you see these big wide range candles, if you can take something off the table, it's a good idea, because for as many of the BNTXs that don't come back, there's plenty like Delta that do. All right. So that's my rationale for getting out immediately yesterday at $7. So I did the right thing. Now that initial candle, and it wasn't a 30-minute, it was a 15-minute, it was right about here, I remember. That initial candle was dwarfed by the end of the day. This thing went from where I got out at 7, right? Later in the afternoon when I'm looking at it, it was at $16. All right. So I'm looking at it now because I just reading most of this book, and I'm trying to be objective, and I'm saying, like, what was the amount of skill or luck in this trade? And the answer was, well, it was more luck than skill. I applied the same rules, with the exception that I didn't get in my my multiple contracts that I wanted to. All right. So I've got to get discretionary here and make a decision. Now, clearly, let me see here. I'm reading this. This is what I wrote to myself. My plan would have been exiting another contract, leaving the third or more available. Yeah. So what I was supposed to do at the end, near the end of the day, when it was around $16, was take another contract off, really solidify a big winner, but leave the third, fourth, or fifth, no matter how many I had, leave them for the run up. But now I'm stuck with one contract, and I have to execute my final contract rule, which is trail stopping. And that bothered me because it opened me up to significant open profit risk. We're trading stocks here. This thing could gap down on Monday, and I could blow half of that gain easily. So in as much as the trailing stop is a logical exit for your last contract, it's not foolproof because stocks can gap, right? So here I'm stuck with this mindset of I didn't want to minimize the trade potential. I wanted to keep the trade open, but I also didn't want to give up a huge and quick open profit if I saw that rally fade. So you can see the challenge. I'm trying to decide what to do here. Now, here's what I look back on and say. This doesn't happen frequently where you're missing on your rule of how many contracts and you've got to make this decision, but it has happened before. And I know that how I get is emotional about the decision. I start to think that no matter what I do, I'm wrong. If I keep it open and lose the gain, I'll be upset. If I close the trade and miss the rally, I'll be upset. So I've got to have a better way of handling this decision than just, being emotional. And this gets back to what I said earlier, which is we don't have enough practice with certain things that are going to happen to us. Right? We just, how do you practice trades like this? You got to have thousands and thousands of trades. And even then, you've only got a handful of them. Right? So I immediately was thinking about Annie Duke's book and this self-serving bias. And I said, all right, I just need to be objective about this. It was a lucky event. Yes, there was skill in executing a strategy that we've researched and we're making money with it. But this magnitude of gain so quickly, right? This magnitude of gain so quickly, had much more to do with luck. And we know, incidentally, what it was. A press release came out that Pfizer is partnering with these guys on a drug that theirs is more promising than Pfizer's. And of course, that just immediately got everybody buying the stock. So that was the luck. Now, I take you back to that unusual option. Did somebody know that Pfizer press release was going to come out and shoot this stock straight up? And I'm going to say probably, because if you looked at the option on this when we were getting in it, it wasn't exactly the most liquid. It had a spread. You had to go in and bid to get in it. You couldn't just go at the ask. It wasn't 5, 10, 15 cents. It was pretty wide. In fact, my first entry was $2, and my recollection on the spread was something like 3 and 1.5 or something like that. So I bid closer to the bid and got filled. And then the next contract, the next day, I got in $1.85 because it had dropped a little. I still had to bid it to get in it. Okay. So an unusual option there with that kind of an event coming out in a couple of days. I'm going to lean toward, this was inside knowledge. Somebody made a killing. Right. All right. So my solution, what am I going to do now that I've read this and I understand that I'm in a pickle, so to say? I first of all acknowledge that as great as this trade performing is right now, that I didn't manage it well. This is not going to be. This isn't a journal entry that says, Mike, you did a great job on this trade. It's easy to think I did because I made a bunch of money, but I didn't. I violated my 3 minimum rule by not paying attention to getting in that 3rd or 4th contract. So I had to be fair and say, all right, forget about it. You want to look at your decision process, not look at what's the result of the trade. Because if you just looked at the result of this trade, you'd be out having, you'd be out at happy hour partying. You'd be sorry, man, I did really well today, but I didn't. And so I had to figure out what to do with this. I was indecisive. I was emotional because of the magnitude of it. And I needed that objectivity. So my solution was I just typed into the WhatsApp group. Many of you are in it. You probably saw it. I just dropped the ego and I said, all right, so what are you guys going to do? What if you were in this situation, would you do? And I thank those that responded. It was very helpful. You pointed me to 2 objective answers that I didn't even think of, truthfully. I was stuck in this, what should I do? And I'm looking at the chart and, And those answers were, first of all, you're going into the weekend, better to take the money now. Anything can happen by Monday to the downside. It's already went up substantially. And then there was some supply on the chart, right? So I felt better when, I had some objective. Now, one person that offered an answer was in the trade, couple weren't, and they were just saying, objectively, this is what I would do. So it was helpful to me, right? Only because I could drop the ego and say, I'm not feeling particularly objective about this. I'm affected by it, and I've got to admit that there was luck involved, and now I need to get out of that frame of mind and into something very objective. So I closed the trade at 1640, very happy with that, obviously. And then watched, you always want to see what happened. And it just crushed that supply level, took it off the chart, and then went as high as 19 and settled down at 1750. But basically, I felt completely neutral and better about the decision. And I'm unconcerned, honestly unconcerned about what's going to happen going forward. And I believe it's because I acknowledged self-serving bias, and I stopped and was objective to get a solution and out of the realm of emotional behavior. I'll give you another example. This one comes right out of Annie's book. One of the greatest poker players of all time is a guy by the name of Phil Ivey. He's won 10 World Series tournaments. And he always surprises his peers at these tournaments, especially when he wins, because all he wants to do when they walk away from the final table is talk with everybody that he respects, all his peers that can make it to the final table of a poker tournament. All he wants to do is talk about in excruciating detail the mistakes he made. He doesn't go out to the bar and party with them. He just wants to review, when it's fresh in his mind, every one of those mistakes. And this is a guy that just won the tournament, right? Now, this is the same kind of attitude that top-notch athletes have, and traders should have too. So the moral of this lesson is simple. You can learn something from your winners and your losers, but you got to apply the process. You've got to do the review, and it's got to be objective, and it can't be, oh, I made money, I don't need to look at that one. Because I can tell you what mistake I'm not going to make going forward. I'm not going to make the 2-contract mistake. I'm going to make sure, what's freshest in my mind right now is I should have a contract or more on this trade right now and have banked all the money that I needed anyway. So get into it, read the book, apply the process to your trades and anything in life, and you will absolutely improve if you can objectively review your behavior. And you know what's going to happen if you don't. And that is today's lesson. Brett's saying, how would you have done it differently with 3 contracts? Okay, so here's what would happen. Right here. Once the second contract would have come off late in the day yesterday. Not at the high, obviously. We never really get those, but certainly about where I got out of it. If you look at the chart, right? This red candle here probably would have got out there. It was a 110, and it doesn't expire till October. So, you're $7 in the money plus time. So that was probably a good 12 or 14 bucks right there. By the time I made my decision, I was out here at 16. But so I would have taken one off there, Brett. And then I would have went to my third rule, which was trail stopping it. Where is that? 3-contract minimum rule. Where is it? Where did it go? Yeah, executing my final contract rule, which is trail stopping, but I didn't want to do that with this one. Why? Because stocks can gap. And if I had three, it wouldn't matter to me if the third contract lost a bunch of money because I already pulled in, 800% gain or something like 700% gain already. So, you don't really care about the last contract. You're just going to manage it for whatever you can get out of it. And if it keeps going up, good. If it goes down, well, then take it out on a retracement. But it was the only one. And that gap down here, I could tell you, all I'd be thinking about on Monday, if this thing opens up down and that contract I sold for 16 is trading at 7 or 8, it would affect me. I'd be like, bad decision, Mike. So that's what I'm not going to do. I'm not going to take these trades without completing my minimum agreement in my plan, which is 3 contracts. Okay. Yeah. All right. So that's it for this lesson. Let's go ahead and wrap this up, and we are going to start our workflow training.